Good morning, everybody. My name is Katie Ensweiler. I'm the marketing manager here at VonLehman CPA Advisory Firm. Just wanted to go over a few housekeeping items. If you could, please remember to keep your mic on mute. It'll eliminate the disrupting sounds in the background. Also, feel free to have video on or off, completely up to you. We are recording this presentation, so in the event you do need to jump off or you miss a portion of it, we're more than happy to send that link out to everybody once the event concludes. We will also be including all of the panelists' contact information. So if you have a one-off question you need to ask them after the presentation, you're more than welcome to do so. If you have any questions you'd like to submit during today's live presentation, please submit them in the chat feature. We'll do the best we can to get to all of them, but if we are unable to get to yours, again, please feel free to reach out to one of the panelists. We are offering 1 hour of CPE as well as CLE for today's event. I will be chiming in 3 different times with codes that you will need for the CPE portion of the presentation. Please take note of those as we are not able to offer them once the event has concluded. So with that, I will go ahead and turn it over to Brian Malthouse.
Welcome, everybody. My name is Brian Malthouse. I'm the president, CEO of VonLehman Company. And I'm sure everybody's getting really tired. Hopefully this is the end of virtual events, and maybe in May, June here, we can start having these events in person, which I find a lot more entertaining. I want to first thank the teams from Thompson, Hine, Wealth Dimensions, and VonLehman for helping put this thing on. And I also want to thank our esteemed panelists who will really share their insights in today's topic. And they're the ones dealing in this every day. I've had a lot of experience, but it's completely different for those that are really involved in this every day. So Emma, why don't you go ahead and start? Each of the panelists will introduce themselves, but we'll start with Emma, followed by Keith, and then Doug.
Sure, thank you, Brian, and thank you again for having me on this panel. I'm excited to chime in on this important topic. My name is Emma Off. I am a mergers and acquisitions partner at Thompson Hine, based out of our Cincinnati office. Thompson Hine is a full service law firm with offices in all of the metro areas in Ohio, Cincinnati, Dayton, Columbus, Cleveland, as well as key cities across the country, New York, Atlanta, Chicago, DC. We have a full service team of specialists here that really allows us to support all types of transactions. Love working with our friends at VonLehman and seeing a lot of names on the RSVP list that are doing deals in this space. So thanks for joining us. Keith?
Yeah. Hey, good morning, everyone. Keith Carlson, and I'm a shareholder with VonLehman CPA Advisory Firm. I actually joined the firm 4 years ago and started the M&A Advisory Services Group. Our group focuses on helping business owners sell their business, acquire other businesses, or in some instances, raise capital. I think most people probably know the VonLehman name because we're traditionally associated with, accounting services, tax services, various attest services for our clients, reviews and audits and things like that. But certainly the M&A piece, merger and acquisition advisory piece, is a very growing segment of the firm, and it's something that we're very excited about. Doug?
Great, thank you. My name's Doug Loftus. I'm a founder and managing member of Wealth Dimensions Group. We're a registered investment advisory firm and advisor for high net worth individuals, business owners, and work in preparing our clients for all decisions as it applies to their family situation, personal situations, preparing for business transactions from both a tax and an estate planning perspective to maximize the impact that they have on their family. So happy to be here. Appreciate the invite from VonLehman to participate.
Thanks, Doug, Emma, and Keith. I will direct each of the questions to I'll kind of rotate as we go down, but each of the panelists will remain unmuted, and anytime you want to have a conversation, add to the content. We'll try to keep this thing as lively and entertaining as we can make it. So Doug, I'll start with you. From a personal financial perspective, what should a business owner think through before deciding to sell their business?
Well, that's a great question. I think we're big believers in having a detailed plan for all of our clients, and a business owner is no different. There's a lot of moving parts and a lot of decision points along the way. The first and foremost is, am I in a financial position to be able to sell or liquidate my business and replace or maintain the lifestyle that I'm living? And the second one is, what preparation do I need to have from a structural perspective and an ownership perspective? Estate planning is a big component. It's not uncommon where we come into a situation late in the process. Sometimes a deal's already done and people seek financial advice once they've had a liquidating event, and they're trying to figure out what they need to do with the proceeds. And it's not unusual in a situation like that where someone has liquidated, the after-tax proceeds they receive are not sufficient to actually replace the cash flow that they were receiving from their business. So a lot of planning is important, and I think generally starting 3 to 5 years ahead of time, so that you have the structures in place to maximize the outcome of any transaction.
Yeah, and this Keith, I would echo a lot of the comments that Doug just mentioned. It's important, if you're exploring a sale or looking at exiting your business, to have a good wealth advisor that puts a well laid out plan that simulates life after a sale in front of you, just to make sure it can satiate your lifestyle, and someone that's going to weave in not just mimicking the cash flow from your business, but also all the dreams and objectives that you've got that you want to layer into your personal life post-close. It could be vacation homes, it could be charities that you want to give to, anything that you want to achieve. You got to make sure you're thinking of that before you pull the trigger.
The other thing that I would add, and Doug, you alluded to this, business owners that we frequently work with, an important consideration is also the benefit of being able to run certain business expenses through the company that they're no longer able to do post-sale. So I think that's just an important consideration for business owners, not only looking at what kind of cash flow do they need post-sale, but also what they're going to lose by selling the business, the ability to run through, certain costs and expenses that they've been used to enjoying tax benefits related to doing so.
Yeah, those are all valuable points. What we do is work with, and any advisor in working with a business owner contemplating a transaction, we build a very detailed cash flow model, and the goal of that is as you work through the process, A, to evaluate, am I ready? B, all of the issues that Keith and Emma have discussed. And then the other part of it is, how do I evaluate the potential structures that may be presented to me at the time of sale? And what's the outcome or the impact on my long-term financial situation and personal situation? As Keith mentioned, I think on the charitable front, there's some really great planning if someone is charitably inclined, if done properly and with sufficient time pre-deal. You can generate significant tax deductions using strategies like a private foundation or a donor advised fund with company stock, for instance, and you avoid the gain on the sale, but you get a deduction for the full fair market value. So there's a lot of different planning opportunities depending on someone's personal circumstances.
Panelists, real quickly, how realistic are the initial thoughts of most business owners regarding what their entity is really worth? Are they usually low, usually high, or usually they're spot on?
My perspective, just in having a lot of the conversations on the front end with business owners about selling their business, it's all over the board. Sometimes people are pleasantly surprised by the value that you suggest you can get for their business. Other times people have an overinflated view of valuation because they're reading, the Wall Street Journal, and they're seeing large public companies trade for, this multiple or that multiple, and they're applying that logic to their company. And then some people surprisingly have a really good grasp on, kind of where their businesses trade, because they've had their nose to the wind of the lower middle market companies that are trading in their sector. So I find it to be all over the place. and there's really no rhyme or reason as to any trend there.
Yeah, Brian, I was going to actually make that point. It's funny because sometimes, we'll have clients that will back into what they need. They'll talk to a wealth advisor like Doug, and they'll say, well, I've been approached to sell my business. I need this. And they have absolutely no reason, justification for why that would be market. They've done no valuation. They just say, hey, this is what I need to sell my business. And then they're surprised when people don't want to pay that. So, it's not based on any kind of third party appraisal. So I think in those situations, before people go to market, it's very important to engage services like Keith's to kind of have a third party advise as to what the value would be worth. Now, of course, it's always worth what somebody is willing to pay in the marketplace. But talking to M&A advisors is really helpful and people that can evaluate the assets.
I would echo that. I mean, I think what I find is a lot of business owners we work with, if they're simply considering what they would pay for their business, it's probably low. If if they're reading the publications and the media, it's probably high. So,
Doug, I had an audience question for you. What items do you recommend a business owner bring before sitting down with you and creating a detailed plan?
Wow, great question. So we have a complete process we work with a client on, and that's both quantitative and qualitative. Again, I think Keith and Emma both hit on that piece of it. Quantitatively, it's all the typical items. It's balance sheet statements, estate planning documents, tax returns. We go through all of that to build a detailed model, because our job is to put the client in a point to evaluate all the decisions, arm them to make great decisions, then teamed with Keith and Emma to bring in more detail on a transaction-oriented basis. We also focus, though, extensively on the qualitative aspects, and that is, most business owners spend their lifetime building their businesses, toiling, many, many hours. And so we work also on the family issues, the vision issues, quality of life, the dreams piece of it. And we try and map that out as part of a plan. There's a lot of considerations. Some cases you exit immediately upon sale. Sometimes you exit a year or 2 or 3 after sale with a consulting agreement of some sort. And we work through all those qualitative issues of considering, okay, how's this going to impact us? Is my wife or my husband going to want me home? How are we going to spend our time? Do we want a second property? So it's both a combination of obviously the typical quantitative stuff. And on that basis, we go very, very deep in the quantitative piece, but also extensively thinking through the qualitative aspects.
Keith, why don't you give us your perspective of everyone's pre-COVID, post-COVID? Hopefully we're in the post-COVID or entering into that phase of M&A activity. What's your thoughts on kind of pre and post, and where are we headed?
Yeah, in short, activity's up tremendously. So, we're having by far more conversations today about business owners contemplating a sale than where we were even pre-COVID. So there's just a lot of chatter, a lot of business owners that are interested. If you look at our live engagements, deals that we have signed up right now in terms of ones that are actually going through with the sale process, we've got double the number that we had at any point in the 2019 levels. So there's a lot of activity on that front. And what I'll say is, as much as supply is up, so there's interest from people wanting to sell their business, the demand is there as well. So there's, no shortage of potential buyers for these companies that we are talking to, or that we've engaged to sell in the market. And the amount of interest that we're getting is just fantastic and tremendous. So I would describe it as very brisk, well above par to what we were seeing pre-COVID levels.
Do you see that continuing for a while?
Yeah, I think so. That kind of weaves into kind of the why, we're seeing some of this. I think a couple of reasons that's happening, why the conversation's up, why engagements are up. is, last year, obviously with the pandemic, there's a number of business owners that postponed their sale. Obviously that did not get to sell their business because they thought it was just a good time to hang back and see the way that the markets were going to react. So I think we're seeing some volume come as a result of that. I think some of the things that we're going to touch on today in a little greater depth is, everyone's eyeing this potential capital gains increase by the current administration. And so a lot of people are saying, if my taxes are going to be nearly double what they are, today, versus a year from now, why not contemplate a sale today? And then I think there's just general fatigue, that's out there right now from business owners. They're used to the strenuous nature of running their business, but when you layer in the fact or notion that they've got to also respond to governing bodies telling them what they can and can't do with inside the four walls of their business, it just creates a lot of fatigue. And so how long is it going to run? I think there's some current catalysts that I just mentioned that'll propel us very briskly through this year and perhaps into early next year. But then once some of the air, lets out of that proverbial balloon, I think it'll restore more to like 2019 levels.
Yeah, I would totally agree with Keith's sentiments there. We are seeing a ton of deal activity, certainly increased over 2019. I think there's a lot of dry powder. People have capital there. Our clients have had no issue securing financing. I know a lot of people were concerned about that. And I would say we're still kind of in the midst of the pandemic, though people are optimistic with the vaccine. So you have access to cheap capital. It's certainly still a seller's market. I know buyers were hoping that would come back down a little bit. And I think a lot of buyers are using this as an opportunity, the pandemic, to acquire assets that could give them a competitive advantage coming out of this crisis. So I think for a lot of reasons, Brian, I see M&A activity staying very robust. I would say through next year easily. There's just a lot of assets out there where, we'll talk about later, distressed assets having to work through the system. And the state of M&A has drastically changed. The pandemic has pushed to the forefront, evolution and behavior, which we can talk about. But it allows people to get deals done very quickly. And like I said, still a seller's market. People have to be willing to pay for attractive targets, and we're seeing them forego over high multiples to do so.
I think cost of capital is near zero. So
right.
I think that's also driving a lot of activity, and we're seeing it. I think to echo, we're seeing this motivation of tax rates being a huge push, the potential for the capital gain change, which I know we'll talk about later. But I think that on our end is probably the biggest question that we get.
We're asking, probably as questions go on, we're asking all the panelists to look into their crystal balls. Obviously, taxation is a political process that it's kind of like sausage making. It's a pretty ugly process. All we can do is use our insights and our history to help us predict what we believe is going to happen. With that, we've talked a lot about income tax and the potential rate increases and how it's motivating people. What about the comments floated out there about estate taxes, a wealth tax, and things that are being floated out there? How is that affecting people's behavior?
That's extensively right now. A business owner can pass on to heirs $11.8 million of assets without tax, either currently as a gift or at death. We have a unified gift tax system, and a married couple double that. We know that that's going to be reduced in 2026 to half. So we had that window that we were shooting at already regarding the ability to do planning. We're not assuming that most business owners liquidating a business are going to pass before then, but there are certainly a lot of strategies that we can employ to remove future growth and future taxes out of their estate. The most recent and probably the most extreme is some recent work from Bernie Sanders, but even the Biden administration, ex-Bernie Sanders, is talking about a potential of reducing the exemption amount in very short order to as low as $3 million. And where that will land, we don't know. There's going to be a big battle in Congress over that. But if that's the case, the ability to use structures to avoid future tax are going to go away. And so there's another piece of code section, not to get too technical, code section 2704, which allowed, and this works with closely held businesses, to transfer assets out of an estate using a discounted value based on minority interests or limited marketability. And that was actually going away in 2016. And it got delayed. We were waiting for final regs in 2017. They got delayed again. And then when President Trump was elected, the whole 2704 revision went away. I mean, it just disappeared. The regs never appeared. That is another thing, the ability to transfer assets at a discount in related party transactions, we expect to go away sometime this year. That piece will go away. Those are all really important planning tools. Again, not that these tools are important from a current death estate tax issue. It's the building blocks that allow us to build strategies to avoid taxation in the future. And to the extent they go away, we're talking about currently anything over the exemption amount is taxed at 40% of its full value. The discussions out there currently go as high as raising that tax to 65% of an estate. That's not on income. That's on, that's on the value of the asset. That's on the principal value. So that's a huge issue. We don't know where it's going to land. It seemed like we were going to get something this year. It seems like the Biden administration may be backing off the 2021, not certain, and giving us a little bit longer window on some of this, hopefully until 2022. Historically, trusts and structures have been in place at least when the bill was proposed, are grandfathered, although there's some really scary language and commentary coming out that there may be a retroactive attempt to tax trusts and other things. So again, where we're going, we don't know, but we know if we don't do anything, it's likely sometime by 2022 to be our options to be significantly reduced.
Brian, I'm going to chime in really quickly with our first CPE code word. If everyone wants to take note of it, it's economy. Economy is going to be our very first CPE code word. And while you're writing that down, we did have an audience question that I'll direct to the whole group. Can the panel please comment on purchase price allocation from both the buyer's and seller's perspective and how that impacts the tax position for each party?
That's a great question. Purchase price allocation, and Brian actually, even though he's not a panelist today, he may want to opine on this as well. But purchase price allocation is a negotiated item. It typically comes up after you've agreed to a non-binding letter of intent with a potential buyer. In that non-binding letter of intent, you're usually agreeing to it either being an asset deal or a stock deal. That has an impact on the allocations as well. But the big point of contention is obviously, buyers are trying to put and stuff as much purchase price in non-goodwill assets as possible. So when they do this, they're trying to allocate it to assets that are basically amortizing quicker, which gives them a larger tax shield. And so that is the push and pull that you're going to go through if you're selling a business on negotiating that, because the buyer's trying to substantiate higher values in non-goodwill assets, and sellers are typically trying to pull as much of it into goodwill assets as possible to avoid higher taxation on depreciation recapture because a lot of people are trying to stuff valuation into fixed assets, things that you've already depreciated down on your current books.
Yeah, I would certainly agree with Keith. The one thing, there are not many stock deals unless many pass-through entities, partnerships, and S corporations. If there is a stock or a member interest transaction, purchase price allocations can be done through various elections both buyer and seller make. Amortization for Goodwill is amortizable to the buyer over 15 years. And, whereas equipment, it's very possible 5 or lower. And the IRS has pretty much allowed buyers and sellers to negotiate. And what the sellers are trying to do is get as much as possible into the capital gain bucket. And the buyers are trying to get as much as they possibly can in faster depreciation. So the IRS has pretty much allowed them to negotiate because it's definitely, it works out in the end. And from a practical basis, rarely do we see purchase price allocations challenged by the IRS.
And Brian, it's my understanding, working with our tax specialist, it's really an issue of timing, correct? So the tax, I just to be clear for the audience, the tax burden would be the same. It's just a timing issue based on how you allocate.
Not necessarily. For instance, if you sold, let's say you're running a C corporation and you sell stock versus assets, that is a
Capital gain. But if it's an asset, I'm talking about in an asset. I should have clarified, in an asset deal.
You're correct. You're correct.
Okay, asset deal.
Yep.
And also, I don't actually, this is a last resort, but I'll have parties if they, because as Keith said, this is a heavily negotiated item. You can just agree to allocate based on the code and kind of punt it to post closing. Again, that's just pushing the ball down the road. I prefer to negotiate it as part of a schedule with the purchase document, but it is possible for the parties just to agree to allocate based on the code. And it's my understanding that usually would favor the buyer.
I mean, what every seller wants to know is, regardless of what the purchase price is, what will I have after tax? And that's what they turn over to Doug and say, okay, can I live on this, or is this going to meet my needs? But that's the number one question. And it's where, tax people spend their entire careers, trying to maximize the after-tax cash to a seller.
And Brian, I think that's just an important piece to remind the audience of. I think a critical piece anytime that somebody is thinking about doing a deal, selling their business, buying a business, always consult your tax advisor. So many structuring considerations involve tax, and there can be huge savings and benefits. I find that some people wait too long to involve tax specialists. I always think that they should be involved early on to decide how to structure the deal, because the tax considerations are critical, and a lot of economic impact can be driven by tax considerations and structuring.
Absolutely.
What Emma's saying there is so true. When we run an active sell side process, we really try to pull together, kind of a really nice, sharp M&A related team that involves obviously the M&A sell side advisor, good M&A legal advisory, great wealth advisory, and tax. Because if you do that on the front end before you approach a buyer or you solicit an offer, you can oftentimes dictate the tempo, you can dictate the structure, and you can have them factor all of these things in before you even go to market. And a good advisor can insist that, hey, this is the way we're doing this deal. It's kind of a, take it or leave it. But if you leave it and you want to change the structure, obviously that could have some financial ramifications for the benefit of the seller if you tweak various structures. So it's much better to get out in front of it before you even start having those conversations versus getting a letter of intent and having them have you react to it.
And I would echo and say, it's not too early to start 3 to 5 years ahead of time, so that you can have things structured and not be forced to make changes, in a year or half a year, or even at approaching deal closing.
Keith, what are structuring of deals different today? Kind of, obviously COVID created some uncertainty in the marketplaces, and we've obviously had some global trade issues of getting goods to their suppliers. What are you seeing as far as deal structured? Are you seeing more earnouts? How are deals different, given some of the uncertainty and what's going on?
Yeah, so Emma said something earlier, and I agree wholeheartedly. Valuations have definitely held up out there. Multiples are as high as they were pre-COVID. I think the one thing I've seen leak a little bit to the buyer is the consideration paid. So the old, kind of the old rule of, 80% cash, 20% holdback, and we put holdback, being seller notes or earnouts or equity rollover, those types of things. That has drifted a little bit to the way of the buyer, meaning that I've been seeing more deals come in, kind of in that 70-30 mix, 70%, 30%, cash to non-cash considerations to sellers. And really what's driving that is a lot of people that are putting businesses out there for sale right now are also explaining a narrative. They're trying to get around this COVID impact to their business. So people were either favorably disposed to the coronavirus, or they were unfavorably exposed to it in their business. And so they're trying to suggest, like, hey, had times been normal, this is the way my business would have performed. And buyers are trying to do that too. So, there's a lot of industries out there that got significant run-ups as a result of the pandemic. And so what people are generally saying is, I'll pay you this multiple, I'll pay you this value, but you're going to have to prove it to me a little bit more. And so you're starting to see more and more earnouts, saying, with buyers saying, okay, I'll believe you now and I'll pay you for it, but you've got to substantiate that, kind of once we get the deal done.
Yeah, I would echo Keith's sentiment, especially for the lower to mid market. I think buyers are looking how to bridge the value gap. So you're seeing more of this contingent consideration. As Keith said, earnouts, seller financing, rollovers, things like that. I think that there's also in the marketplace, a validation of the economic recovery. A lot of these companies had some kind of benefit PPP loans, so we're still not entirely sure how they're going to come out of the pandemic. So this is a way, the contingent consideration is a way for buyers to hedge their bet a little bit. We also see a lot of negotiation over COVID add backs and what are certain expenses that, just are related to this pandemic. Again, that may not be there in a year or so. So I do think he's accurate, especially in the lower to mid market. I see it less consideration and more cash up front. The larger the deal size, again, for various reasons, the bet may not be as risky to a buyer. But I do think that those contingent considerations are a good way for buyers and sellers to kind of align on, a misalignment in value and still some uncertainty in the marketplace moving forward, given the economic and pandemic related concerns.
Emma, you kind of relate or hit on it a little bit. Obviously, you've got a lot of businesses with PPP loans and retention tax credits. What is that making deals more complicated? How are we working through that?
Yeah, absolutely, Brian. So I would tell you, this year, I think I've closed a lot of deals, and the majority of those have had PPP loans involved. Banks have departments just specialized in loan forgiveness for PPP, doing M&A. I recently closed a deal. JP Morgan had 700 forgiveness applications just for people doing deals and trying to seek forgiveness. The SBA issued guidance in September of last year that if you have a PPP loan that's outstanding at the time of a change of control sale, you would have to escrow the amount of those funds during the forgiveness process. So I find that most parties do take that route. The funds are escrowed at closing, and then once forgiven, returned to seller. That would be in contrast to just treating it like debt and paying it off at closing like other traditional debt. Of course, a seller who is confident that it will be forgiven, but should be very hesitant to having it treated like debt because they lose the benefit of the forgiveness. But the banks, do have these processes in place. And please keep in mind, if you have a PPP loan outstanding, you will need to get the consent of the bank and the SBA to transact. So I say that I had a deal where the bank was so jammed up with forgiveness applications for people trying to transact that we couldn't even get the consent. It delayed closing about a week because, again, you need the consent, set aside the forgiveness and the escrow. But once that gets moving, it's very easy, and the banks have very standard escrow forms. And then again, once it's forgiven, it's released to the seller. So it's Brian, it's really no big deal. It's kind of a part of life now. Everyone's, a lot of people who are in the M&A space are familiar with the process, and it really should go off without an issue.
And again, we're processing a lot of PPP loan forgiveness applications. And while it's jammed up to a certain degree, most of them are going through no problems. I don't think we've had any of them even over 2 million. A lot of them are just being delayed, but none of them, as far as I know, have been thrown out because of technicalities or anything else.
Right. That's been my experience as well.
All right. Keith, this was a question kind of from the panelists, or not the panelist group, but the audience group. Something about, in essence, if I don't know that I really don't have a great succession plan, whether it's family members or management team, I don't know if my company's really saleable. What advice, if you were called into a situation like that, what do you look for to try to help them through that process? Or do they just close it down? It's maybe they don't foresee a lot of value in the company, but maybe they're not looking at a strategic buyer that would have a management team that come in and run it. So it's maybe worth more than they think.
Yeah, I mean, I always tell business owners that are contemplating closing it down, consult several people before doing that, because there's inherent value in a business that you've built. There's something to sell there. Now, it may not, be game breaking money, but there's something to sell. You've built a business that's producing income. Even if you're key to the business and you've done a poor job at succession planning, give it a go, because there's plenty of buyers out there that can solve for your succession issues. That said, in an ideal world, and I know this is easier said than done, you're kind of premeditating that succession issue in your business, and you're starting to think about adding depth to your org chart to make yourself redundant before you go to sell your business. And look, some business owners that I run into are better at that than others, and that's why, honestly, this gets into a much deeper conversation about types of buyers for your business, right? Ones that tend to have a really poor succession plan in their business, haven't done a great job at creating redundancies. Those are kind of auto, strategic acquirers. Someone that's in your industry that can make you redundant immediately is the most logical path in terms of exit options for your business. If you've done a poor job, but you can hang on for another, 3 to 5 years, or, even a few more, sometimes bringing in a private equity fund to help you monetize a substantial portion of your business, but can bring you the help, not just in succession planning, but other areas of your business. That's a viable option as well. But certainly, consult as many people as you can before you throw the keys in the air and say, I'm turning the lights off, because I think there's value to what you built.
I would also just add to that comment, Keith. When people are having a hard time finding a potential buyer, or buyers having a hard time finding a target, sometimes people don't think about going to industry experts, trade shows, conferences, things like that. Of course, getting a banker, they have a ton of a wide network, but there's a lot that can be done if you leverage the industry and your contacts within the industry and starting to talk to people at trade shows and conferences, to see what, potential opportunities to transact. So I would also keep that in mind.
Brian, I'm going to chime in with our second CPE code word. So again, anybody that needs CPE, please take note of this. It's outlook will be our second code word, outlook.
Thanks, Katie. Doug, from your perspective, under whether the administration's basically Democratic run or Republican run, historically, what's been the economic kind of growth under each administration? Is there a significant difference historically?
There actually isn't. And if you actually looking at the stock market performance, for instance, it actually performs slightly better under Democratic administrations than it does under Republican administrations historically. Not a significant difference between the two. The market's pretty forward-looking. I think where there may be impact is, or there has been impact, is for those investors in the market, those business owners in the market, how much of the gains they get to keep, because tax policy has tended to be more favorable under Republican administrations and under Democratic administrations. So I think there's a little bit of a balance between capital and labor and who's favored under one versus the other. Part of the reason I think that is that when you have a Democratic administration, there tends to be a slightly greater philosophy of wealth redistribution. And even in the context of the discussions going on today, with higher corporate taxes and more wealth redistribution, we'll remember that when capital earns a return, those with capital put their money typically back into capital. They don't go buy more cars and more boats and more high-end items. Whereas if you redistribute some of that to those who have less, the money ends up back in the economy. And I think that because they tend to, anybody that has less capital that receives it through wealth redistribution tends to, or more government spending, tends to see that end up in economic growth over time. So over the long run, I think there's a little bit of distribution, change in the distribution of economic growth, but I think overall, the total return in GDP growth is pretty close to flat, one versus the other.
And I think, Brian, a lot of people have been focused on tax reform under the Biden administration. One other area that M&A practitioners are also focused on is antitrust reform. Generally, more progressive lawmakers, want to reinvigorate competition, protect the consumer. We certainly are seeing this in tech, healthcare, pharma. Some Democratic commissioners of the FTC, recently came out with a strong stance on, vertical combination. So I think that the big regulatory changes under the Biden administration will be tax for M&A and, antitrust, again, reinvigorating competition, the HSR thresholds for when you'd have to submit your, a deal to the FTC and DOJ for review, was reduced from 94 million to 92 million, cited COVID reasons, but certainly we're expecting more second passes at the reviews, which may kind of chill some of the larger deals, more scrutiny on tech, pharma, healthcare, like I said, and vertical integration. Data privacy is always going to be a focus of the administration and who owns what. And then I think we'll see localization, less cross-border transactions because many governments, are kind of focused on the concerns with competition, and we've seen the chilling with China. So I think antitrust should also be on people's radars as far as reform under Biden.
Thank you. We're talking M&A here, which is usually at the top end of companies, maximizing their value, but obviously not all businesses are doing well. Are we seeing more bankruptcies out there? You don't read about a lot of them other than the big retail chains.
And you're not seeing, Brian, you're not seeing them. So The bankruptcy for personal and for corporate are down, I think pre-2006, the levels are low. I remember when the pandemic started, I spoke with a lot of bankers and M&A advisors, and everyone was thinking, we got to pony up, we're gonna have a lot of bankruptcy, a lot of distressed sales. Really, that has not come to fruition. There's been a lot of, government has the CARES Act has helped stabilize things. I think people have continued to have cheap capital. So that has staved off some of these bankruptcies, out of court solutions. People don't want to hold these assets, so they find commercial solutions without going through the process. General uncertainty and an optimism for the future, Brian, I think has also held off bankruptcies. I don't think we're going to see an uptick this year. I do think because those distressed assets are going to have to work through the system, and currently they're working through the system, I think out of court and through negotiated terms. I think though at some point there's going to have to be a faster process. So end of 2021, 22, we'll probably see more Chapter 7, 363 sales. That would be, the sale and liquidation of a business. Chapter 11 is very expensive and a longer process, though under the CARES Act, there is a process for small business debtors. Those are debtors having less than $7.5 million of debt to do a Chapter 11, less burdensome, quicker, I think 90-day process, more benefits to the owners. That subchapter V of Chapter 11 in the bankruptcy code actually expired at the end of last month, but President Biden on April 2nd extended that for another year. So I do think we'll see small business debtors take advantage of that. Again, I don't think we're going to see these distressed assets work through probably until early next year. I do think they'll work through at some point. I don't think it's going to be the bankruptcy boom that people were expecting. I also think businesses have done a very good job of pivoting. I mean, if we look at restaurants who have gone curbside, online ordering, I think retail needs to move from brick and mortar and get an online presence, and the faster businesses can pivot, the better they will do. Real estate will be interesting to see.
Yeah, we're seeing the same thing at VonLehman. They're just not really seeing any bankruptcy.
Right. We all thought it was going to come, but fortunately it hasn't.
Yeah. Doug, what, from your perspective, Emma touched on it a little bit, that many business owners kind of forget about the perks of whether it's car allowances, country clubs, even though they're non-deductible. There's a lot of things that are paid by a company that people kind of forget. And people that are now on a fixed income, regardless of how big that fixed income is, change their mindset to say, I have to pay for my own car and these type of things. What other types of mistakes do sellers, owners of a business kind of make in your perspective in going through the sale process, more from an emotional standpoint?
Yeah, I think, well, so you've hit on a couple of the big pieces from a tax, and was mentioned earlier. What I'm going to realize after tax and whatever the structure of the sale is, what's my lump sum going to be? That's a big one. Secondly, I think, as you guys work with business owners to recast P&Ls, to pull out all of those numbers that are personal expenses that come off of the P&L, I think we work really diligently to try and categorize it. I think the biggest mistake is, and the biggest adjustment is the mindset of, I'm used to having a regular cash flow coming from my business. Now, all business owners, none of us feel differently, is the cash flow can be uneven, right? But we're confident that we run the business, we make cash flow, we live off of it. And there'll be cash flow next year, and there'll be cash flow the following year, and there'll be cash flow the year after that. I think working through I now have a finite pool of money, and I don't have that future cash flow of my business. That is an emotional change. And that doesn't matter whether you're a business owner or anybody who retires and is no longer getting a paycheck, right? Because it changes your mindset as far as how quickly you're willing to spend, what you're willing to do lifestyle wise, necessary expenses. And I think that's the emotional part around having to live off of a finite lump sum of money as opposed to ongoing cash flow is the biggest, probably the biggest adjustment. The other one is just simply for someone who's been toiling, 50 or 60 hours a week running a business, filling up all of that time, because now, you're not used to having to fill time, and it's exciting for the first. My experience and our experience is for the first 6 months to a year, it's kind of cool. You play golf, you travel, you do those things that you haven't done as frequently or as readily as you might have when you were running a business. But then what happens after the first year of excitement's over? You've done all those things that were on your bucket list, and I have to fill up another 20 or 30 years. So I think those are all pieces of the component. Other areas, many people with businesses, the other family members benefit, right? There's other family members that have been involved in the business and how it impacts other family members. And I think a lot of pieces, it's different, Brian, from one circumstance to another. That's why we spend so much time in our discovery process. We like to identify those well ahead of time and work through them. You never get to the final answer. Look, the day that deal closes and the cash flow from the business stops, that is the biggest adjustment. So
that's a great. Go ahead, Emma.
I was just going to ask Doug, how many of your clients utilize the resources available at the Gearing Center, for instance?
I would say a fair number, or something like the Gearing Center. There's some we use Aileron, or there's different similar programs, and not exactly the same as the Gearing Center, sure. But I would say a subset. I couldn't put a percentage on it, but and there's those that go right head first into it, and they think they're ready. I think but they're not. I mean, it's really important to work with somebody who's really thoughtful in helping the business owner, helping an individual think through these issues that are going to be presented, and that they're going to have to deal with. And I can tell you, sometimes it's as much as I said a little bit earlier, I've not been around my spouse as much, and they each have their own lifestyle. And
well, the pandemic has certainly forced many of us to spend more time together than we were used to, right?
Yeah, there's been some preparedness done with COVID. That is a big issue. That's one that we get often. I don't want him home with me, or I don't want her home,
Right.
He's gonna, I have my own life. I don't want
M&A thing with VonLehman and Thompson Hine. Very interesting.
That's a good segue. We're coming near the end here, so I want to give each of we've had a great conversation today, give each of the panelists an opportunity to give their final thoughts, words of wisdom to the folks on the call. So Keith, why don't you start?
Sure. Yeah. I mean, look, this is a topic that's, kind of front of mind for not only business owners, but, their advisors that are coaching them as well. And so I would encourage you, I mean, these pending and potential tax changes, I mean, they're a real deal. I think what's been eye-opening for a lot of the people that we've worked with is just kind of showing them, kind of the hold versus sell analysis, growing your business for another couple of years and kind of what that means from a net proceeds analysis to you in your company under, a changed tax regime. It's pretty eye-opening. So run the numbers if you're contemplating a sale for yourself over the next year to 2 years, as you might be surprised at the difference you'll get 1 year versus, call it year 2 or year 3, depending on when these tax changes come through.
We'll go ahead and go to you next, and maybe if you can just briefly touch on the possibilities of a retroactive tax increase?
Was that me, Brian?
No, Emma.
Oh, Emma. Okay, good.
Anybody can answer it, but I was,
Okay.
go ahead and give Emma a chance.
Yes, sure. So I would say the pandemic has been disruptive to a lot of our behavioral processes. M&A is no different. I think it's really pushed along the process. Deals can be done a lot faster. People can no longer say we have to schedule management meetings, you know, XYZ. Now you can just get on a Zoom the next day. It has M&A was already being done very quickly, and this has just accelerated it. I would advise our audience members to embrace the change, use the tools available to keep the momentum, keep an open mind, because the marketplace is so competitive, and I believe it will remain competitive for the next couple of years. We're seeing a lot of alternative transactions, partnerships, joint ventures. Some buyers want to try it on for fit, invest, you know, minority investment, and have a right, you know, to buy later at a certain value. More companies and private equity is looking at venture capital. We certainly see this melding of venture capital and PE. So I think the pandemic has been disruptive, but has really fostered getting deals done. Diligence can be done more accelerated. You're not doing the in-person meetings, which I actually think is to the detriment. It's always great to get in a room, but there's a lot of things in place that have allowed for acceleration, and it will continue to change the way we do deals. Doug, I'm going to kick it to you on the proactive tax.
Yeah, okay. So just kind of summing up, I would encourage anybody who's, you know, well, anybody in general, but if you're contemplating a transaction, seek really good quality advice, and really think through the transaction ahead of time, the lifestyle issues. There's a lot of people out there that will do a very rudimentary analysis, for instance, on sustainability from a financial perspective, but I would use no less rigor in what you do with your personal life and your long-term than you do with your business. And a lot of people treat the personal side much more casually than they do their business financials. And I think you need to do that with very deep rigor and lots of granularity. So I would encourage on that front. On the tax piece, you know, there's not a strong history of retroactive tax legislation. I think Brian can probably remember when we had short-term, mid-term, and long-term capital gains hit in the middle of a year. Back on some legislation. I can't even remember what year that was, but it's a number of, for those who've been around a little while. My fear is, well, the couple things that, one thing that didn't get brought up is stepped up basis. And one of the things in the state tax area that is being discussed and income tax is that when someone dies with an asset, the basis that the beneficiaries receive is the value on the date of death. And I think this is going to run, and I think this will probably get bipartisan support. Where if I bought, I'll just use an example, it applies to a business, Procter & Gamble for $1, and I pass away and it's worth $135. I have $134 of gain in there that I have to pay tax on if I sell it. If I don't sell it and today I leave it to my heirs, their tax basis is $135. That gain just disappears. Part of this legislation or the proposed legislation is floating around is to do away with stepped up basis. And in fact, there's two ways they can do that. One is a carryover, which just means the beneficiary gets the basis of the person they inherited it from. So in the Procter & Gamble case, their basis would become the same as mine at $1. They're also more recently talking about applying a capital gain tax upon death, where you have to pay the tax on the gain. And the concern is that's a forced liquidation, because a lot of times there's not enough liquidity, especially for a business owner. where it may force the sale of a piece of property. There's been recent talk about maybe spreading that tax over 10 years or something. But, you know, all of these issues, retroactivity, I mean, to me, that's somewhat retroactive, even if it goes into effect January 1st, because it applies to, you know, existing gain that is present in assets. So I'm not, there seems today to be a little bit of movement to push off the individual tax portion to 2022, but I don't want to take away the urgency of getting something done or being prepared for it ahead of time. The area of retroactivity that causes me a little indigestion is taxation of trusts, and there's a lot of vehicles that we have used on a regular basis to avoid taxation of income and future appreciation. And I think there's people hard at work trying to figure out how to bring that back into the tax fold. And that's going to be a battle. That Brian probably is the area of retroactiveness.
Yeah.
Typically things have been grandfathered historically. That piece of it gives me some concern as to whether or not they will attack existing structures in the code.
Yeah, I think what becomes very obvious here is this is a very complicated area. Our panelists have shown you how in depth their knowledge is, and you've got to seek professionals when you're contemplating these transactions. And I can't thank all three of them enough. You've done a great job, and I'll turn it over to Katie to kind of wrap things up and give us the last code if you're interested.
Great. Thank you so much, Brian. And as Brian mentioned, thank you so much to our partners, Wealth Dimensions and Thompson Hine. We couldn't have done it without you. Great planning the event and executing the event with you guys as well. So that last code word is impact. Again, you will need all three of those codes in order to obtain the CPE credit, and we will send out a follow-up email with the link to the recording, all of the contact information for our panelists and our moderator, as well as instructions for both CPE and CLE. So with that concludes our event today. We thank everyone for attending and have a good rest of your day.
Thank you.
Thank you. Thanks, Emma. Thanks, Keith and Brian.